Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
So glad to have you here today on the College Investor Audio Show. Today, we talk about how to use your tax refund to possibly build your credit. Yeah, it's possible. So let's get right into it. By late January, early February-ish, most of us have forgotten our New Year's resolutions. It happens. You know, the ones to save more, to build your credit, that type of thing. But tax refund time represents one of the best opportunities to make good on those resolutions. No kidding. So if you've struggled to build your credit in the past, you can use your refund to build better credit. But you can't simply buy a better credit score. No, that's not how it works. Instead, you need to deploy the funds strategically to ensure that you're boosting your score as much as possible. Okay, so we're partnering with our good friends at Self to help you understand how you can put your refund to work to build your credit. Now, let's first talk about the components of a credit score, because that's where a lot of confusion is. It's kind of complex. Before you can start to put your refund to work, you need to know how credit building actually works. So the credit system may seem a little bit confusing, but knowing the basics can help you find the best use for your funds. Payment history. First things first, let's talk about payment history. That really just measures your record of making on-time payments for your debts. It accounts for 35%. That's a big chunk of your overall credit score. And then utilization ratio. You've probably heard those words. The utilization ratio is the amount of money you owe relative to the amount of credit available to you. Credit utilization accounts for 30% of your overall credit score. Quick math, we're already at 65%. And unlike what your high school football coach may have told you, I know mine did, we're not going to 110%. We can't. That is impossible, coach. Sorry for the rabbit trail. Okay, back to reality here. Length of credit history was what we'll talk about next. So length of credit history, that's pretty self-explanatory. It's the average age of your credit accounts, and it accounts for your most recent credit account opening. People with longer history tend to have higher credit scores. Length of history accounts for 15% of your credit score. Credit mix. Credit mix is the number and type of loans you have. Lenders often want to see your behavior with installment loans. Installment loans are student loans, auto loans, and personal loans. And then your behavior with revolving credit. Revolving credit is like credit cards. So credit mix accounts for 10% of your score, which leaves us with 10% left, which leads us to new credit inquiries. Credit inquiries indicate that you've asked a lender for a new form of credit. Typically, the credit scoring companies group loan inquiries for a mortgage or an auto loan together. They understand that people may want to shop around for the best rates, but a lot of recent credit inquiries for personal loans or credit cards are a huge red flag for lenders. They worry that you may be desperate for cash. New credit inquiries account for just 10% of your score, but that's a significant chunk as well, so don't, take that lightly. So here's how a tax refund can help you build credit. As we've talked about all of those things, a tax refund is pretty much a cash windfall, and it won't be directly reported to the 3 major credit bureaus. However, if you receive a refund, you can put your new funds to work to build your credit and stabilize your overall financial situation. So here are 3 ways you could use the money to help you build credit. Pay down maxed out credit cards. This is huge. Credit utilization accounts for a whopping 30% of your total score. When you've maxed out credit lines, your credit score takes a big hit, and lenders are less likely to extend credit to you. Paying down debt is one of the fastest ways to improve your score. When you reduce your credit utilization, your credit score tends to see an immediate boost. Ideally, you're going to want to aim for a credit utilization ratio of less than 30%. If your credit card has a limit of $500, you'll want to owe less than $150 on the credit card at any given time. When you use your tax refund to pay down your credit card, your credit utilization will fall, and your score should see a little boost. Using a tax refund to pay off your highest interest loan can also feel like a huge victory in your journey to become debt-free. That, by the way, is the end goal. Debt-free. When you pay off an entire card, your minimum payments fall, so you can direct more money to your least favorite debt, aka all of them. Keep it as an emergency fund. So putting your tax refund into a savings account, that's not going to immediately build your credit, but holding cash on hand can keep you from borrowing on credit cards or using payday loans. Oh, man, that makes my skin crawl. If you face an emergency. So the average tax refund for the 2020 season, by the way, was $2,827. That's quite a bit. If you receive a similarly sized refund in 2022, you'll have more than enough to cover a car repair, an unexpected parking ticket, or repairs for a broken appliance. Holding money in cash isn't exciting, I know, but it does help when life doesn't work out as expected. There are always rainy days. Think about it. Cash on hand means you won't have to decide between making your loan payments or handling the emergency. By continuing your debt payments, you'll not only reduce your credit utilization, but you'll also improve your payment history, since your payments can stay on track during an emergency. And here is the third thing you can do. Use it to open a credit-building loan. People with no credit may need a little bit of a jumpstart to build credit. Folks in this camp may want to use their tax refund to take out a credit-building loan. A credit-building loan is a personal loan where borrowers make payments for a set time, often 12 to 24 months. The borrower's payment history is recorded at all 3 credit bureaus. At the end of the loan term, the borrower receives the cash they saved less any interest owed. Companies like Self offer these credit-building loans. So aspiring credit builders can choose between monthly payments of $25 to $150 for their first credit-building loans. People who have historically struggled with building savings and credit may use their tax refund to jumpstart their credit-building loan. Borrowers can deposit their refund check into a brand new account separate from their main checking account. Then, they can set up auto payments from their new account to get their credit-building loan. By automating the payments, by the way, borrowers ensure that they'll keep up the great credit-building behavior. You can dive deeper on any of the things we talked about today in this article at thecollegeinvestor.com. There are links to Self where you can find out more. You can also open a secured credit card. So a secured credit card is basically, they just require users to make a deposit that secures the line of credit. So here's a quick example. A person might put down a $300 deposit to create a $300 line of credit. Then, that person can use the credit card and pay it off regularly. This creates a track record of positive payment history that can increase a person's credit score. Banks just want to see a trend of positive credit-building behaviors before extending larger loans like a home mortgage or a low-interest auto loan. Using your tax refund to secure a credit card gives you the chance to start demonstrating this behavior to the banks. Several credit card companies offer secured credit cards, but many of these cards are laden with high fees and impossibly confusing terms and conditions that are like 100 pages long. Self allows its borrowers to open a secured credit card using their credit-building loan account as their security. If you want to use the Self Financial Visa credit card, you must open a credit-building loan first and build $100 in savings. Not too difficult. Then you can open the secured credit card. Having both a personal loan and a credit card improves your credit mix, which may boost your score. It will also help you build credit provided that you make timely payments for both accounts each month. You can use your tax refund to set this all up with Self at thecollegeinvestor.com. Now, a little word of warning. Avoid these tax refund pitfalls if you're trying to build credit. A tax refund allows you to kind of reset, build your credit. But there are pitfalls that credit builders should avoid at tax time. Refund advance loans. We don't like these. Unlike typical loans, refund advance loans may not be reported to the 3 major credit bureaus. While you'll pay interest and fees, you're actually unlikely to see a boost to your credit score from taking out one of these loans. Putting down a down payment on a vehicle you can't afford. A tax refund is an excellent windfall, and many people want to use the funds to put a down payment on a car. In a lot of cases, this could be a good use of the windfall. Unfortunately, people with limited or poor credit history are unlikely to find a reasonable rate on a loan. Rates on auto loans can climb as high as, get this, 36% in most states. If your auto loan has rates in the double digits, you're going to struggle to afford the payments. Buy here, pay here car dealerships often take advantage of people around tax refund time. You've seen the signs. They require massive down payments. Then they issue loans that many people are going to struggle to repay. Borrowers who miss their payments on their loans are likely to have their car repossessed. In the process, the missed payments will destroy your credit. If at all possible, try to build your credit before you need an auto loan. This will help you look like a better credit risk, and you should see lower interest rates on future auto loans. Paying for improved credit. Okay, so credit repair, quote-unquote, companies often advertise that they can improve your credit score for a fee. Typically, these programs do absolutely nothing but dispute negative credit events on your credit report, which you can do yourself. But if your report is accurate, disputing information isn't going to do anything, and then you're out the fee. While the companies may not succeed in helping you build credit, they will succeed in taking several $100s away from you. They're great at that. Avoid these scammy companies. The only way to build credit is to demonstrate positive credit behavior by utilizing the tips we've shared today. Which leads us to just a few final thoughts, then we'll wrap this up. You only get your tax refund once a year. Instead of spending it on something that you'll lose interest in a few weeks later, this year, use it to build your credit, which can help you get on a path of better financial results across the board. Remember, a higher credit score can help you not have to pay security deposits for utilities like cell phones or power, get lower insurance premiums, be able to rent that apartment you've been waiting for, get lower interest rates on car loans and mortgages. Basically, improving your credit score can actually save you a lot of money. And using your tax refund with tools like Self's Credit Builder account or setting up a secured card can go a long way to making that happen. Check out Self once again, and thanks to them for partnering with us on today's podcast. You can find it at thecollegeinvestor.com. All you have to do is just copy and paste the title of this podcast into the search bar, and you'll find it in all the links you need. Thanks again for stopping by today. We'll talk to you again real soon.